Hey, I'm Angela Sticca Synder, founder and CEO of Taxinista, and I've got a good friend here with me today, Eric Elam with CalChoice Financial. We're going to go through some fun and interesting facts on the different investing you can do, the savings, the different tax brackets, and all that cool stuff. So stay tuned to us.
Hey guys, I'm Eric Elam. One of the things I'm excited to be able to talk to you about today here with Angela is taxes. Now I know that might not seem like an exciting subject, but most people don't actually understand how taxes work, and financial advisors are most guilty of this. They're busy talking about investments and leave taxes to your professionals. However, we need to understand this because we have to work together like a team. So what we're going to do today is make it very, very simple. We're going to break taxes down to a very simple level so all of us can understand it. Where we really want to begin is just how do taxes work? In America, we've got a thing called a progressive tax system. What does that even mean? Well, it's very simple. You might remember back to high school when you had those long, tall cylinders in science class with little lines on them called a graduated cylinder, right? You poured water on the top and it slowly filled up. Well, our tax system worked kind of like that. The first money that pours in is taxed at 10%. Then the next amount is taxed at 12, 22, 24, 32, 35, and now 37% is our top tax bracket. That means even the mega wealthy people like Jeff Bezos and Bill Gates, even they pay some taxes at 10%, if only for 3 seconds the whole year, and then they fill it up for the rest of the year and they're paying in that top tax bracket. Well, that's how our tax system works. Many people get confused saying, well, I think I pay 22%, or oh, if I make a little bit more, now I'm bumped into the 24%. It's not that all of our money is taxed at that rate.
That's so funny. I'm so glad you explained this. I did another quick little video on this because most people have no idea how tax brackets work. And I know that when they come in and they say, or they call me and they say, how much more money can I make so I don't get in the next tax bracket? I'm like, make all the money you can, okay? Who cares if you're in the next tax bracket? Because it tells me they don't get it. So they think then that if they make more, that next tax bracket is where they're paying all their taxes. And it's not, we know that. And so that's why it's so important to understand this and the different savings mechanisms as well. And also we're gonna go over at the end what's gonna happen in a few years. So stay tuned on that for sure.
Absolutely. So yeah, when we break into the next tax bracket, if we go $5 over, that means only 5 of our dollars are taxed at that next tax bracket. That's why there's also a thing called an effective tax, what you ultimately pay over the whole year. So those are taxes, and that's how our tax system today works. Yeah. Now, when it comes to saving though, whatever we're saving, we're not going to talk about investments today. We're just going to talk about taxes and savings. Yep. There's 3 ways the IRS allows us to be able to save money. We're going to refer to these savings vehicles as buckets. So the first bucket they allow us to save in is what's called the taxable bucket. The way the taxable bucket works is you receive it from your job, you pay taxes on it because the government's wonderful and just takes it straight out of our checks now, right? And then they allow us to put it somewhere. And when you put it someplace, any growth you get on it, it's taxable again. What are some types of accounts you think where you pay taxes every year? What are taxes?
And these are the kind of things I ask people for. If they have a checking account that's interest bearing or a savings account, or you know what, this happens a lot. You open up that checking or savings account and they give you $100. Okay, that's considered interest, and people forget about it.
The whole 100?
The whole 100.
I didn't know that.
Yes. So they'll forget about it, and then we file their taxes, and then they get a notice, and they're like, why, they still owe tax on this $100. I'm like, well, yeah, that's interest, because they're going to tax you on it. Nobody gives you anything for free, unless it's your mom giving you a gift, okay? Otherwise, you're going to pay tax on it. So yeah, interest. So we've got checking, interest, stocks. You invest in stocks, mutual funds,
bonds, things like that, brokerage accounts, any just type of market investments that aren't in something that's tax protected.
Correct.
Now, you get, how do you know you actually have one of these taxable accounts? What do you get?
A 1099. So on the list of things we need to get your taxes done, you'll know if you have it. You'll either get a 1099 interest, a 1099 INT, 1099 DIV, or a consolidated one, which is what most people have if you've got your investments in any kind of like larger brokerage house. So that you'll get all of them condensed into one.
So you end up getting these little 1099s, and it sounds like a tax document. What really it is, it's a love note. It's a love note.
It's not a love note.
It's a love note from the financial institution. Congratulations, you made money.
Yeah, true.
However, the IRS made money too.
Yeah.
Feel free to send them their cut in the form of a tax payment.
There you go.
And that's what we're doing. So congratulations, you made money. Make all the money you can. Just know that someone else is investing with you when you're in this bucket. So what we want to make sure that we do is understand there's a correct amount to have in each of these buckets. Now, financial advisors all disagree about a lot of different things.
Of course, yes.
Right? But one thing they can all agree on is the correct amount to keep in this taxable bucket. This is money because the benefit of having money in this bucket is it's liquid.
Yeah,
right?
it is.
You can get it whenever you need to.
You can't have your cake and eat it too, right?
Right.
So you can't get a great mortgage and have like no money on your tax return. Same kind of thing here.
Yeah, that's a tough one for a lot of business owners. I
Yeah,
absolutely know.
it is, which is probably another video. So stay tuned for that.
Absolutely. So that liquidity money that we need liquid, it's going to be taxed. So we only need to keep a certain amount liquid. Advisors agree, regardless of where they are, it should be about 3 to 6 months liquid to cover emergency expenses.
Yeah.
So that means if we have more than 3 to 6 months in brokerage accounts, checking accounts, savings accounts, etc., we have too much in this bucket. We're creating a tax problem by saving too much. Who thought we could have done that? But at the same time, you can have too little in this bucket. So the moral of the story is that there's a perfect amount to save in each of the vehicles the IRS will allow us to save in.
Yeah.
So that takes care of the first bucket, the taxable bucket. We pay taxes on it every year as it grows, and it continues to grow, but it's liquid. That brings us to our second bucket.
Second bucket.
Bucket number 2.
Okay.
It's the most popular, most well-known bucket in the American populace right now. It's called the tax deferred bucket. In this bucket, we don't pay taxes every year. When do we pay taxes?
When you pull the money out.
So can you think of some examples of accounts where we do not pay taxes today, we pay taxes later?
Yes, and this is what most people are familiar with. So if you have a job, a traditional job, or you're with the government or a school system, you're used to a 401k or a 403b. Others are probably, let's say they don't offer a plan to you, then maybe you're used to an IRA or an IRA. Ooh, I was gonna say something, which comes up in number 3.
We've got SEPs, Simples, Kiosks, defined benefit plans. If you're the owner of a company and you're highly compensated and you're making a lot of money, it might be something to look at in place of a 401k.
Yeah.
Right? Those are some great things that are out there. Now, all of these accounts have very different IRS tax codes,
Yeah.
but they have 3 areas in which all of them agree. The first one is that when you put money into these accounts, you get a deduction. Now, do we like deductions?
We do like deductions. It's not really, it's a deduction. So you don't have to pay the income tax on the amount you're putting in. So
Right.
yeah, it's
So
a good deduction.
you make $100,000, you put $10,000 into your investment, account your IRA, 401k, whatever. You're then able to pay taxes on $90,000.
Right.
So it reduces the reportable income.
Right, and these aren't the exact numbers. Refer to the specific tax year to look at the right numbers. We're just using general numbers here, guys. To make it easy,
Absolutely.
okay?
Absolutely. So obviously work with your tax professional when putting away money. We'll be able to work with people like Angela who can make sure that we stay on that straight and narrow path.
Yeah.
So what we want to do next is talk about this. First is the deduction. Now deductions are fantastic. However, they may not make sense to take this specific deduction for everyone.
That's
It
right.
depends. Do you think taxes will be higher for you in the future or lower for you in the future?
I think they're going to be higher. I think they're on sale right now. You know, ladies, when you go and you buy something and you get stuff on sale, how great it feels. I sort of think taxes are on sale right now. So this sort of information is really important.
So now you said a very interesting thing, and I want to have a conversation about this. You anticipate that taxes are going to be higher. Now,
I do.
Thinking taxes are going to be higher and knowing for a fact they're going to be higher are 2 different things, right?
Correct.
Absolutely. Now,
Who am I? It's just my opinion.
Now-
who am I?
if we did know the day taxes were going to be higher, would that be an important thing to know?
That would be an important thing to know. And I think we do know. Can we see into the future? Right now we can.
Stay tuned. We're going to take it at the end of the video. We're going to tell you the exact date and the exact rate taxes are going to go up to. So you're going to want to pay attention to that because it's going to be important to how do you save money in these buckets. So that takes us to thing number 2. All of these accounts agree on. One is you get a tax deduction.
Yep.
Thing number 2 is that they all have a special word. The IRS has a special word for the money you take out of these accounts. How do they treat it?
They treat it as ordinary income because you originally earned it at your job or working at the time. You didn't pay tax on it, income tax on it, so now you are going to have to pay income tax on it.
Exactly. You're merely deferring
Yeah.
the receipt of that money.
Right.
You're still receiving that money as income, just at a later date. So what this means is that you end into a business partnership with Uncle Sam. The problem with this business partnership
Yeah.
is the fact that Uncle Sam can vote every year on the percentage of your business profits he gets to keep.
Yes.
So unless you accurately can predict what taxes are going to be in the future, you don't know how much money you have.
Yeah.
You saved $1 million, you have taxes at say 30%, you've only got 700,000. But if taxes go up higher, you have less available to you.
Right.
That brings us to area number 3. The last thing all these accounts agree on is that eventually
Yep.
you will be taxed.
Right.
Right?
Absolutely.
Which there were just some changes on this year. It used to be 70.5, but as of this year, it's now 72.
So that means you have a little bit longer before you have to pull money out of your taxable investments.
Absolutely. And so what we have is we have these investments, we're able to put the money away. We get the deduction now, which is fantastic if we need the deduction.
Right.
If we don't need the deduction, then we want to take a look at something else. And that brings us to bucket number 3. This is the least paid attention to bucket in the tax structure. Most of us are always looking for that instant gratification. Get my tax deduction. I just want it. It's the best thing. Everybody's telling me I should get it. And all my friends at the water cooler are doing it.
Right. Right. But that doesn't always mean it's the right thing to do. Or to put all your eggs in one basket. One time I had a client that put all their eggs in one basket and they ended up in bankruptcy. So this is also something you should do for investing, is sort of diversify it. So definitely do some tax-free and tax-deferred, but also this third bucket's really important.
Yeah, the third bucket is the tax-free bucket. So here's the thing. You want to diversify your investments, you should also diversify your tax income streams. Because as things change, it may be more beneficial to have one than the other, and having multiple means you can control it. So the tax-free bucket is one that's a little confusing because some people have heard of it, some people haven't heard of it. There's a lot of things that like to pretend they're tax-free, but aren't. There's 2 rules you have to pass in order to be truly a tax-free investment and qualify to fit in this bucket. The first thing is that you must be truly tax-free. Now, this is confusing to a lot of people because that's the name of the bucket. But in order to be truly tax-free, you have to be free from federal tax, state tax, and capital gains tax. Now, something that pretends to be tax-free is a municipal bond. We're often sold on TV. These are a great tax-free investment, and they are always free from federal tax. But are they always free from state tax?
No, they're not. It depends on, each scenario is different sometimes, so yeah, it's not.
Absolutely. If you buy one in Ohio, Arizona doesn't give you a state tax deduction for that. Of course not. And then if you've heard this word diversified, you should own a lot of these things. So you buy a mutual fund, you then owe capital gains tax on them.
Yeah.
So that means an investment that's been largely touted as tax-free isn't. And this is why you need to work with somebody who actually understands taxes. Because if you work with somebody who doesn't, they're going to tell you something and be incorrect, and then you'll pay the bill to Uncle Sam later.
Yeah.
This brings us to test number 2. Test number 2 is that, this is a fun one, I want you to talk on this one for a second, that money you take out of it cannot make your Social Security more taxable.
It cannot, because this bucket consists of Roth IRAs and Roth 401ks. So for instance, in this tax-free bucket, you pay tax on the income when you earn it, okay? And then it grows exponentially tax-free. Doesn't that sound amazing? Yes.
Absolutely, and the point that we want to really talk about is the fact that Social Security, how many people do you know that don't know about Social Security?
Social Security, people think Social Security, you paid into Social Security all year long.
Felt like a tax.
Yeah, not all year, all these years long, right? And then now you start collecting Social Security and people think it's not taxable. It is taxable if you have other income on your tax return. It's really important to have money in different buckets, because if you have a lot of tax-free money, you can pull that money out and it doesn't affect the taxability of your Social Security. Absolutely. So it's really important to have money in those buckets because people think it's not taxable, and it is if you are earning income.
Yeah. We're going to do a whole nother bit on Social Security later on, so pay attention to our future podcast and talk about what makes your Social Security taxable versus not taxable, because if you properly distribute your money among these 3 buckets, you can pay 0 tax on your Social Security, and that can mean hundreds of thousands of dollars to you in retirement by simply just not having to pay that tax bill.
Right.
So money coming out of this bucket, it cannot affect your provisional income. That's what makes your Social Security taxable. So money coming out of Roth, like she mentioned, do not affect that. However, municipal bond income does. Right? So making sure you understand what's truly tax-free. The only other thing that even qualifies under the IRS guidelines for tax-free is life insurance, but it only makes sense in certain situations to even consider that as an option. So what we have the 3 buckets. We have the taxable bucket, the tax-deferred bucket, and the tax-free bucket. Now you might need to think about, where is my money currently? And regardless of where your money is currently, there might be an optimal way for you to shift your money into the correct buckets to take advantage of a tax sale. Because you guys like to buy things on sale?
I like to buy things on sale.
I love to buy things on sale. So what we want to do is, how do we decide which bucket our money needs to go into? And if we have it in the wrong one, how do we make some changes to that? So the biggest thing, the question that you have to ask yourself is, will taxes be higher or lower in the future? Because a lot of people talk about this thing, the seed and the harvest, which you would rather pay on. If taxes never change, if taxes stay exactly the same, it actually doesn't matter.
Right.
You put it in one, you put it in the other. If taxes are identical, your tax bill would be exactly identical in the amount you have. However, if taxes change 1%,
Right.
go up 1% or down 1%, then one bucket is better than the other. If taxes go up 1%, then you're better off being in the tax-free bucket. If taxes go down 1% for you personally or for the country, it makes sense for you to be in the tax-deferred bucket. Working with somebody who can actually help you understand what that's going to be is pretty critically important, right?
Yes. Yes, it is.
So what we want to talk about now is we talked about the fact that we expect taxes to be higher. I mean, I'm sure all of you agree right here, like with our Social Security running out of money, Medicare running out of money, national debt continuing to explode, they're going to need more money in the future. But when will it go higher? Now, we happen to be in a very unique situation we haven't had very often in our country. We know the exact day taxes are going to go up.
Yes, we do.
And we know the exact amount they're going to go up to. That date is January 1st, 2026. Do you know why that is, Angela?
Yes, because that's when the Trump tax cuts expire.
Absolutely. So we are now in the lowest tax bracket we've had in almost the last 80 years, right? Even that all-time lows, and we know it, and they expire on a specific day, and they're going to go back to our 2017 tax brackets.
Right.
For most people, that's going to be a 3 to 9% increase. You guys are going to be able to see that some of these taxes, that 12% bracket goes to 15, 22 is going to 25, 24 splitting and going to become 28 and 33. And for some people in the higher brackets, it's going to go even higher.
Right.
So if we understand taxes are low right now and they're going to be higher later, what would you rather pay, now or later?
I'd rather pay now, I'd rather pay now. Which I'm sure is another thing that people could also look into. And we didn't talk about this before, but starting to move some money from the tax deferred over into the tax-free bucket, planning some of that now.
Absolutely. You know, that's one of the things that we specialize in, and you'll
Yeah.
find that if you just simply have, probably most of you watching this video have the bulk of your money in the tax deferred bucket, and you're realizing that we're paying taxes later on that, and if we know that right now for the next 6 years taxes are lower,
Right.
how could we pay the taxes on it? Well, there are ways to be able to shift the money between buckets and minimize that tax bill over your lifetime.
Yeah.
So if you want to take a look at that, maybe we'll do another video.
Yeah.
And we'll get another video time to go through exactly how do you shift that money, what does that look like, and what would that mean for you guys. So hey, if that's something you're really interested in, guys, please comment, let us know that you want to see that, and we'll get a time to record it for you.
All right. Thanks so much for listening to us, guys. Take a look at the link below. There's more way to find out some more information. Have a great day.
Thanks,
Bye.
guys.